thanks for sitting through. There's a lot of information that gets thrown at you in these 2 days, so I appreciate the attention and the perseverance to sit through all of this information. And I'm glad you're here because there's 5 of what I think are some very interesting and prospective companies sitting beside me, so I'm happy that you're going to be here to hear what they have to say. First, I'm going to talk about what my outlook is at this point. And the summary is right there in the title, which is I see sort of 2 possibilities for where the markets broadly and then therefore the metals markets are going from here. And no matter which of those 2 paths we end up on, I think they both work well for gold, which is great. Only one of them works as well for base metals, but I'll go through that situation. Now, to talk about where we're going, you have to start with where we are. So the situation today in terms of the stock market, don't need to spend a lot of time on this. We're all investors, so we pay attention. Investors generally in the broad stock markets want to remain confident, have that confidence that they've had from this long bull market, but fear is definitely rising, right? And that makes sense because from the low in January, from the high in January to the low in December, global markets lost $20 trillion in equity value. That matters, right? And so when you have a loss, when you start to have losses of that scale, investors realize that the days of just throwing a dart at the S&P, buying something and winning on it are limited, right? Maybe they're going to continue a bit more, but the uncertainty is there, the fear is there. And the FANG stocks are a good example of that. They certainly have been the ones that have led this broad stock market higher for 9 years. They lost 20% in the second half of last year. Those kinds of losses matter. The losses are happening because growth itself broadly is slowing down. And it is slowing down because of these trade wars, primarily. It's also slowing down because the economic expansion is getting long, but that's a fairly nebulous thing to say, right? What's long, short, these time ranges vary a lot. But what's not so nebulous are tariffs. The tariffs that have been implemented, and then all the uncertainty around what tariffs might yet be to come. And then there's Brexit thrown in on top of that, let alone geopolitical uncertainty that's ramped up considerably in the last few days. But growth is slowing, and this PMI chart shows that around the world, growth is definitely slowing. Also important, certainly, when you're talking macroeconomics, are interest rates. And here the story is, oh, how quickly things change, right? So in 2018, the Federal Reserve, for the first time in this tightening cycle, did exactly what it said it was going to do. It said it was going to raise rates 4 times, and it actually raised rates 4 times. So that was pretty significant. And of course, raising rates 4 times increased the strength of the US dollar, increased real rates, and that was that. And as of only a few months ago, there wasn't any specific reason to believe that the trajectory would be any different this year. But then it all changed. Then we had this big stock market slide in December, and the Federal Reserve really softened its stance. So now Powell has said enough dovish things that the market is pretty convinced rate hikes are done. The chart that's up there shows market expectations for the federal funds rate at the end of this year, and the big bar there is for 80-something percent, 83%, think they're going to be exactly where they are right now. So the market generally thinks rate hikes are over. That's a really significant change. Within all of that context, it's no great surprise that gold is getting some pretty good attention. So we're up 12% in 6 months. That's a really lovely chart for me to be able to put up, right? As someone who speaks about gold a lot, for the last 2 years we haven't had quite such a lovely chart to be able to put up there. And gold is getting attention because of all of these classic safe haven reasons, right? Concerns about growth, stock market uncertainty, a pause in the strength of the US dollar, and real rates that are now sideways because we're not expecting any more interest rate hikes to lower if we get any inflation. So that's a classic safe haven buying situation. What I think is really interesting is that this chart, which Scotiabank put together, demonstrates that the reasons that people are buying gold have actually changed quite a lot over the last 6 months. Now, this chart was put together, call it 6 weeks ago. So it shows what was happening, what was correlated with gold 6 months ago. So that would actually be 7.5 months ago because the chart's a little dated. So 6 months ago, a month ago, and today. So what matters is the gray bar shows that 6 or 7 months ago, the thing that was most strongly correlated with gold was commodities. So 6 or 7 months ago, people were buying gold as part of a commodities argument. They were seeing economic expansion, that commodities outperform late in an economic expansion, and they were buying gold as part of that commodities complex. As of now, or a month ago when this chart was put together, the rationale has changed completely, and the correlation is now not with commodities, but is instead with the US dollar inverse, with the yen, with volatility, and with short-term real rates. So the rationale for gold has shifted in 6 months from a commodities complex to a safe haven argument. So that's pretty interesting in and of itself. Okay, so then what's next? The two potential paths forward from here, I think, really depend on the elephant in the room. Prepositions matter. And that elephant is the trade war. So what is going to happen? Are we going to get a trade deal between America and China or not? I think we are. Those countries are very motivated to come to terms. Will those terms address all of the issues at hand? Not a chance. They're far too complex and far too deep for them to all be addressed. But they will come to some sort of terms that will help resolve some of this uncertainty. If we get that deal, then fear eases, we get certainty, we get growth resuming because a lot of business has been put on hold because of not knowing what business is going to cost with tariffs, and we get markets going again. That markets going again is probably the classic late stage euphoria part of the bull market. Within that scenario, that commodities argument gets its chance to go. And I'm going to go through how strong the fundamental arguments are for base metals and therefore how well they're likely to perform as long as they're given a chance. And the chance that they need is having a trade deal so that certainty in growth, in economic confidence returns enough that they can trade on fundamentals instead of fear. Within that context, though, gold would still perform. As that chart showed, gold performs as a commodity, so if commodities are rising, it'll get some buying from being one of those, but it would also get safe haven buying because experienced investors would realize that no party lasts forever, that the stock market isn't going to go on forever, and so they would use some of this rally to sell their positions and rotate into safe haven, so gold would get buying on that front. So that's the deal side of the table. The other side is, of course, the we don't get a deal side, which I think not very likely, but it's still important to pay some to consider what would happen in that case. And if we don't get a deal, I really think that the broad stock market rally ends, confidence really deteriorates, we don't get a rebound in growth. The unfortunate side of that is that I think base metals would be largely denied the opportunity that they really deserve, but they would be denied it because that's what lack of confidence would do. Instead, though, gold would really shine because the safe haven argument would be first and foremost. So no matter what, I see gold as being very well supported going forward, but base metals really depend on whether we get a trade deal. Okay, so let's go through those two sides a little bit in a little bit more depth. If we get a trade deal, we would get certainty, and that certainty would enable the growth that has largely been put on hold to resume. And that really matters because the lack of growth is one of the things that's really pulling markets down. We will replace some fear with confidence, and I think the lack of supply in base metals would really start to come to the forefront. As we'll see in a moment, the fundamentals for these commodities are quite shocking, the gaps that we're looking at. But all through 2018, nobody paid attention to the fundamentals. We traded on fear instead. If we get a deal, it would probably also weaken the US dollar a little. The US dollar is bought as a safe haven, so it has been supported because of the uncertainty. It would probably come off a bit. Again, support for commodities. And as I said, we would still get support for gold. So let's go through the base metal argument a bit. Assuming we get a trade deal, where are these base metals? Are they situated well? Well, the answer is they're situated very well. Metals always perform late in an economic expansion, and the reason is just straightforward, that miners are really slow to make decisions to respond to growth, and then when they do, mines take approximately forever to build, and so metal supply is always lagging behind demand as demand is ramping up. And when we get to this late stage expansion, demand for metals is at its highest, sentiment around commodities is at its highest, and metal supply is insufficient. That's why we get base metals outperforming late in an economic expansion. And so that depends on there being growth to create that demand for metals. And we're not talking about a 2006, 2005 situation where we have this China machine that's really coming on board and we have these insane growth numbers and this is propelling demand in sort of shocking ways. But we don't actually need to have that kind of machine driving the demand right now, because the gaps are that big. So even though the forecasts for global growth are fairly moderate, as long as you take sort of moderate, middle-of-the-road forecasts, we still don't have enough copper. We still don't have enough of most of the metals, and therefore even moderate growth is enough to create a pretty strong base metals market, assuming we get a trade deal that gives them the chance. So if we want to look at these metals individually for a moment, copper went into deficit last year, a bit of a surprise, but it went into deficit already last year. There isn't enough copper. There won't be a surplus in copper for a few years now. That can't change, really. It just takes that long for new supplies to come online. Stockpiles are not tiny, but they're definitely shrinking. All told, copper is always a very tight market, and tight markets are sensitive to disruption. And now it's a tight market with not a lot of buffer, because those stockpiles are pretty low. Copper's always threatened with disruption. Right now, I think the key threats in the copper market are Grasberg, which provides 2% of the world's copper, is going from an open pit operation to underground block caving. We can certainly hope that that happens smoothly, but we can't assume that it will happen smoothly, because that would be very optimistic. The Vedanta smelter in India remains, its permit remains revoked because of environmental issues there. There's ongoing water restriction issues in Chile. So there's certain specific things that are happening right now in the near term to support the copper price. And that's a really common thing. Copper is a tight market, 21 million tons a year. There's always just like a few 100,000 tons surplus or deficit. Like, it's always a tightly balanced market, so it's always sensitive to disruption. Those are the disruptions at play right now. So that's the near-term stuff. Bigger picture, we're not producing enough copper. There aren't advanced projects that can be put into production to change that in the next 4 years. And if demand goes beyond current forecasts because of perhaps further stimulus from Beijing, or electrification moving faster than expected, or simply growth going farther than is currently expected, then, you know, the deficits get even more serious. This copper chart shows that just recently the price has broken up through the 200-day moving average. It formed a double bottom when it did so. Does that show investors positioning for growth? I think it potentially does. Huge amount of information on this slide. I try not to put so many words on a slide, but I was trying to get through all the rest of the base metals in one slide, so I did my best. So zinc certainly had its big price move already, right? 2016, 2017, this price of zinc went up 130%. It lost about half of that ground and is stabilized at about $1.20 a pound. That price move incentivized new production, but that new production has gotten us to the point where the market now is expected to make just enough zinc to meet demand. But again, tight markets are sensitive to disruption, and with zinc, there is no stockpile to cushion that, to cushion any disruption. We're down to 5 days of stockpile for zinc, and a lot of that 5 days stockpile is in New Orleans, where it was all flooded after Katrina, so we're not actually sure of the quality of it. So there's basically no stockpile for zinc. So a tight market like that is very sensitive to disruption. The biggest input to supply this year is the Century's tailing project, huge tailings pond that's being reprocessed. It has several % zinc in it. That's great. Again, hopefully that ramps up without hiccups, but there may well be hiccups. So zinc is a tight market. If there's disruption, we could see some near-term price upside. If growth takes off more than is currently expected, again, we could again see another push in zinc. But at the end of the day, even if things just stay as expected, it's a tight market. Therefore, the price should remain well supported through this period of commodities push. I could speak about uranium for the entire 20 minutes, so I will basically say nothing because it's too difficult to get into the story in short. Major structural deficit ahead for uranium. Will that deficit create a bull market at the same time as this commodities market? I don't know the answer to that. There are reasons to believe that it could, specifically this Section 232 petition that's before President Trump. If he decides that America's reliance on imported uranium threatens national security, which he may well do, that could be the kick that sends uranium into its next bull market. I don't know exactly when that's going to happen. If uranium doesn't enter a bull market, I don't see that as a downside. I don't see that as holding the commodities market back in any way, because uranium is kind of its own animal and people don't worry about whether it's aligning with other commodities. But if it does move into a bull market at the same time as the rest, that's like fuel on the fire, because uranium markets are crazy when they happen. Nickel is certainly undersupplied. It will remain in deficit for years. Stockpiles are still fairly healthy for nickel, so there's a big cushion there, so nobody is super excited about near-term nickel prices, but I think the fact that it's significantly undersupplied means that it's well supported, and I think you can look at iron ore, look at metallurgical coal, and see reasons for the prices to remain supported. You may not see a huge amount of price upside, but I think there's good reasons to see those prices supported. So that's base metals being really primed fundamentally. So if we see growth, if certainty returns, if we get an influx of confidence because of a deal, base metals are going to have a great opportunity because the fundamentals are so strong. As I said at the beginning, though, if we do have that scenario and we have another leg in the stock market, base metals get going, I still think that gold will do well. And that's because it performs both as a commodity, so it gets to play that game, but it, of course, also performs as a safe haven, and there's lots of investors who would be buying it as a safe haven even as the market continues to go, because they know that nothing good lasts forever. I have a few charts here that show exactly that. So this is just a great chart that shows, we always talk about gold as a safe haven, but this is a chart that tangibly captures just how precisely gold is the opposite of economic confidence. So credit spreads are a great confidence indicator, right? They show people's confidence in the economy. So credit spreads widen when confidence falls, and credit spreads tighten when confidence is going up. So that's what's charted in black. And charted in gold is the ratio of gold to commodities. And you just do the ratio to sort of take the US dollar out of the equation and show gold on its own. And they track together so closely. Gold just is the opposite of economic confidence. And because of that, if we get no deal, gold is going to do really, really well, right? This shows how gold gained 7% during the 11 sustained market crashes since 1987. This focuses in just on official recessions since the 1970s. There's been 6. Of course, that means the stock market's down more than 20%. Gold's been up on average sort of 21%. Gold does well when everything else is not doing well. Gold equities, of course, almost always baby in the bathwater situation at the beginning. They get a bit chucked out if there's a real sort of chaos event, but they soon detach and start to rise along with the metal in those situations. Why am I so certain that everything's going to fall apart completely if we don't get a trade deal? These are some of the sentiment responses that came along with one of the recent PMI, manufacturing surveys. So they gather their data from manufacturers, their numbers, and they calculate their numbers, but then they also take sentiment comments. And so these are some of the sentiments that came out with that recent survey. And they're in every category, the issues are specifically mostly tariffs and some Brexit. So if we don't resolve the tariff issue, these things just will continue. And if anything, will get worse. So I really do think that things are going to fall apart if we don't get a trade deal. Okay, I have exactly 1 minute left. So what do we do from here? Well, we certainly pay attention to what's going on the trade negotiations front. This is sort of a drawn-out process. You know, you keep hoping that there's going to be some sort of resolution, and you keep having to wait. If it becomes apparent that there will not be a trade deal, which I think unlikely, but if that does become apparent, then I think it is time to exit base metal positions or be willing to hold them for the longer term. Those fundamentals won't change. We're still looking at deficits in copper and deficits in nickel and the like, but fear will trump fundamentals, and it will be difficult to make money in base metals if we don't get a trade deal because there will not be the perception of economic growth, and so then markets won't respond that way. Whether we get a deal or not, it's time to position in gold. And I could spend a long time going through this, but at the end of the day, it's really easy Anybody who's at this conference is clearly interested in early stage exploration stories. It's very easy to fall in love with those stories. They're exciting. They're my favorite stories as well. But my counsel is to make sure that you spread your bets. In a new emerging gold market, you don't need, I mean, it's great to make a 10-bagger on an exploration story, but you can also make 2-3 times your money, which with much lower risk if you buy producers, if you buy project developers, if you buy assets that are moving through the de-risking process while still having strong exploration results. So spread your bets amongst the stages of companies so that you can moderate your risk somewhat, because all of those opportunities, I think, are going to do well in gold over the next little while, because it is set up to perform no matter which path we take forward from here. So that's my talk. I speak quickly. I apologize if it was a bit too quickly. These are my products. I publish 2 different newsletters. One is a weekly focused on higher risk stocks, what I'm buying, selling, and thinking in the sector. There's also a monthly newsletter that's designed for more generalist investors who want to be introduced to how to invest in metals and have lower risk investment ideas. The premium service is for those interested in participating alongside me when I invest in private placements. And that is what I have to say. So, without further ado, I will move on to our presentations here.